Dollar General is a stock that I've been following for a while. It is on the tracker. I have built a model on it. However, I haven't spoke about it on the channel. And really what I was doing is I was waiting a couple of quarters to see this story play out. And now we're starting to see that things are getting much worse for the dollar stores in general. Dollar General's shares actually went down by 10% in the last trading session. And the question is, what exactly is going on? And is now the right time or a potentially good time to purchase the shares, as we've been presented with somewhat of an opportunity? And so in this video, I'm going to take a look at it and provide you with my perspective. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And so right off the bat, you can see that the company's shares plummeted yesterday by 10%, but this isn't the only decline that the company's seen this year. You can see that last quarter when the company reported, the shares went from above 200 down to the 160 level. And so overall, over the past year or year to date, the company's down close to 44%. And now, you know what piqued my interest is as the company continues to decline, it's now trading at a pretty low PE ratio, albeit this is a trailing 12 months PE ratio. And so here's where the model really helps. And here's where, you guys having access to the model, you can see how I'm forecasting this out. And so does this PE hold? And that's something that we'll walk through as we go through the model. But first, I just want to cover the story. So the stock actually tanked because the company cut its outlook. So you can see it right here. The shares of Dollar General are sinking after the retailer reported a drop in quarterly profit and cut its sales and earnings outlook. Now, they are saying that you should be expecting a profit headwind for the remainder of the year, which will of course bring down their EPS estimate, which they do provide to you guys. And just a reminder guys, this isn't the first time that they've slashed guidance this year. Recall that last quarter, they actually reduced their net sales growth guidance to 3.5% to 5%. From 5.5% to 6%. And so, management is having a credibility issue, or sorry, investors are having a credibility issue with management. But truthfully, you're just in an environment right now where there isn't a lot of visibility. And so the management teams can only do their best. But as things continue to deteriorate, as the consumer is pinched by inflation, it just creates an environment for unpredictability that these management teams have to navigate. And so going into the highlights for the second quarter, the one thing that I found very interesting about this, the reporting that I saw early on for Dollar General, is that the media really sensationalized the shrink, so basically like theft. But if you pay attention to what management is telling you, you'll see that inflation is hurting the business in two ways. So I think it's less of a story about theft and more of a story about inflation. And so here's how it's impacting the company. First, price sensitive consumers are buying lower margin products, mainly consumables, and the company obviously just makes less off of these lower margin products. And second, the same inflation that has hurt their consumers has also pushed up retail wages. So the company is making less money, but they're paying more money to operate the same business. And so you can see it here. The gross profit rate decline is due to a greater proportion of sales coming from the consumables category, which generally has a lower gross profit rate than other product categories. So consumers are pinched. I mean, you could overall have higher sales at lower gross margins, so you make more money, but that's not what's happening here. Their overall sales are declining, or the growth rates are declining, and at the same time, the gross margins are coming in. Now, interestingly enough, I predicted around a 31% gross margin, so I just got lucky. A broken clock can be right twice a day anyways. And so the other part of it is that the primary expenses that were a greater percentage of net sales in the current year period were retail labor. That's the first one that they call out. And so here's where they are facing higher labor costs. And I know I spell labor like a Canadian, deal with it, guys. Now, the other thing is, because this company has a lot of debt, interest expense actually doubled when you compare to last year. So this is why a clean balance sheet matters in this environment. Hence why I've been charging the valuations of companies with debt since day one. But the other thing is now that you're starting to feel the pinch of higher interest rates, management have to really take a stance on what they want to do. Do they want to continue to experience this and pay out that excess free cash flow, or do they use it to pay down debt? I think management should be using that excess capital to always be paying down debt, especially if it's a lot of debt, like in Dollar General's case. And that's exactly what's happening. So you're now seeing year to date, the company's no longer buying back shares. The dividend still holds for now, but the payout rate or the payout ratio is creeping up. So my question is, and I'll answer it in this video, is the dividend under threat? But first, I want to tie off this story. So the Wall Street Journal has picked up on the fact that dollar stores are flashing warning signs on consumer spending. And so it's not just Dollar General, but Dollar Tree also are saying that shoppers are shifting spending towards food and essentials. These are lower margin products. Now, this is not a new story. If you were listening or reading the conference call transcripts from the last quarter and reading their earnings releases, you would have seen that this is the exact point that they made in the last quarter. So if a lot of people bought the company's shares on the dip, well, one of the risks you would have run is that consumers would further move towards spending less at the dollar stores and only buying the necessities, which are lower margin anyways. And so you could have a further deterioration in the business. And now that's not what we're seeing. And so it wasn't super predictable. And this whole economy is really just not predictable. We all thought that we'd be in a deep recession by now. It hasn't happened, but we are seeing continued signs of deterioration. And I wouldn't be surprised at all if we see continued deterioration in the next 2 quarters, but it's just a wait and see to see how it plays out. And so let's get into the guidance. Now, I have copied this and placed it in the model because I use it to forecast out the business. So you guys have access to this right in the model. And I've been putting more and more of these guidances that I'm using to build out my models right in the model, so you can see where the information is coming from. But you can see that the company expects an incremental operating profit headwind of approximately 170 million in the second half of 2023. That's going to bring down your EPS. So here's the new net sales growth rate. Remember, it was previously 3.5% to 5%. Now it's down to 1.3 to 3.3. So the fact that they're still growing sales is good, but of course it's come down. Now, same store sales growth in the range of a decline of approximately 1% to a growth of 1%. Now recall, they will give you same store sales growth and number of new stores to break out how to build up the revenue growth. So they're saying that 1% or actually maybe even 0% if you go to the midpoint of this 1 to 3 to 3.3 is coming from same store sales growth. So really what they're telling you is that at the midpoint, all of the growth in net sales is coming from new stores being opened. Now, you can see that diluted EPS in the range of approximately 710 to 830 is a decline from the last forecast that they provided. And of course, they're giving you the tax rate. And here's where the new store openings come. So 990 stores. I think this amounts to around 5% of an increase in store counts in the year. And that, of course, is largely what's driving the increase in net sales. Now, interestingly enough, here's where I was a little bit surprised. All the talk about gross profit margins declining. Gross profit margins actually were in line with what I was expecting. And the reduction in profitability overall is going to come from the SG&A line, this line right here. And you can see that it has really picked up from 22.7 to 23.8. And I think it goes higher. And that management is telling you that it's going to go higher. And so now let's go into the tracker and pull up the Dollar General model. And so if you guys are not familiar with the tracker, this is what you get access to when you join the Patreon. And so, this is all opened up. I've graded out right now, but you can click into the specific model that you're looking for. And so, for example, here you can see Alibaba. It's all sorted on share price as a percentage of intrinsic value. And you can get access to the tracker at the lower tier of the Patreon. And if you want to join us for live calls every month, I think these are a huge value. You can join us at the upper tier. There's just about 200 people that are a part of the team right now. And just going into the model for Dollar General, you can see that, the increase in store count by 990 stores, it is a 5.2% increase overall. But notice that it doesn't really jive with the increase in revenue for the company. That I just gave them the midpoint of their forecast, so 2.3% in revenue growth. Obviously, gross profit, I'm keeping it around that 31%. SG&A, I brought it up a little bit, and really what I did was I just kept moving this up to get my EPS in the range that the management team were expecting the EPS to come in at. Obviously, net interest income, they're telling you that it's doubled since last year, so I've just doubled it over here. And then of course I've used the income tax rate that they're providing. And so, when I think about the business going forward, I do believe that the the store count will continue to increase. I'm a little bit pessimistic here. I'm actually giving them 2%. I'm sure it can grow faster than that, but you guys already know that I tend to be very pessimistic in the way that I value companies. And really what I like to do is I like to give companies just small steps to step over as opposed to huge hurdles to jump over. And then if the valuation is cheap, even from that perspective, then it's a huge opportunity to purchase. So that's generally how I work, but you guys are going to model this completely different, and it's totally cool. And so of course, same store sales, I'm predicting a little bit of a growth in the subsequent year, and then of course settling in at around 1.5%. Obviously, if this is going to grow at the rate of inflation, you're probably going to see probably like 2, 3, 4%. But once again, I'm being a little bit conservative here. Also, I'm bringing down the SG&A as a percentage of revenue back down to its historical average around 22.5%. I'm leaving everything else for now, and so that's how I'm getting to close to $10 per share in 2024-25, and then around $12 per share 6 years from now, or I guess 5.5 years from now. So that's kind of how I'm getting there. So if you want to think about this stock from a high level, you can probably think of it as like a $10 stock, which is currently trading at $138. So what is that? Just do the math quickly. So it's around a 7% equity yield. It's not a bad valuation or not a bad price for something that can turn into a $12 stock in 6 years, which would give you a 9% equity yield or an 8.7% equity yield. So just something to think about. But equity yield is not everything, and that's why we don't exactly purchase securities based on just the equity yield alone. And here's why: because I didn't see a deal here last quarter, and I'm still not seeing a deal even though the price has come down to this 138.50. And here's why: I'm valuing the company at approximately $160 per share. However, I'm penalizing their balance sheet, or I'm penalizing the valuation for all of the debt on the balance sheet. And so, you have a valuation that's actually lower than the current share price. And so, a lot of people can look at this and say, look, you're being too pessimistic in your forecast, and you're being too tough on them with respect to how you're charging them for the excess cash on the balance sheet. I tend to be the same across the board. I'm like this for every company. The only companies where I might give them a little bit of a break on their excess cash penalization would be something like a H&R Block, where the debt's not coming due for 10 years, so I'll discount the debt. Okay, fine. That's kind of really the most that I'll do. And so you can see that it's not actually a 13 times forward PE ratio. Based on the guidance that they've provided, it's an 18 times earnings forward PE ratio, which provides you with a 5.5% equity yield. But remember, guys, that you're not getting all of that because you're using some of that to pay down the debt. That's not necessarily a bad thing, but it's just something that you have to be aware of. And then the thought that's on everyone's mind, will they cut the dividend? I actually don't think that the dividend is in jeopardy. I can't spell jeopardy, but I think a dividend cut would really help the company pay down some of that debt in this higher for longer interest rate environment, because you can see that it has ticked up. We were at 26% payout ratio for the quarter or for the first half last year, and now we're at a 36% payout ratio for the first half of this year. And so I actually encourage management to seriously think about cutting the dividend. They're likely already weighing the pros and cons, but overall, you guys know how I think about this. I think you should always do what's best for the business. Right now, you can make a case for either side, but I really believe that if you cut that dividend, you're going to have a lot of the dividend yield people who are really just looking for the yield exit the position. It creates a wonderful buying opportunity for value investors, but the management is not really interested, of course, in creating opportunities for value investors. They're only interested in doing what's best for the business over the long term. And I think you can make an argument that cutting the dividend would be a really good idea over the long term. It gives the company back around $1 billion of free cash flow, which you can apply to the debt, and the debt's around $7 billion. So I would be interested in even just keeping that dividend cut for the next 7 years or whatever, just to get all of that debt down to zero. I know this management team likes to operate with some debt, but I think, where it currently is a little bit too high. And so you guys let me know in the comments what you think. And guys, just an FYI, Foot Locker is up somewhere around like 30% from that $15.50 per share, which it opened at after earnings. And so is this Dollar General another one of those situations where the share price did decline a lot after earnings, but now it could start picking back up as people come in with their buy theses? I don't see it, but you guys let me know. But also, if you want to get access or see that Foot Locker video where I covered that whole situation, you can actually take a look at that video right here.